Good morning. This is Dylan Jovine from Behind the Markets. Happy Tuesday. Today is December 17th. What a blessing it is to be alive today. Wow. So today I wanted to talk about a little story that wasn't picked up by many people, but I certainly kept eyes on it last week. The world's biggest active bond fund manager is a company named PIMCO. And those of you guys might be familiar with PIMCO, huge company, might manage some of your retirement accounts and assets. And there was a guy named Bill Gross who used to run the PIMCO funds, and a very famous investor. He's on CNBC all the time, and he's around and he talks to people, and he's a very shrewd investor, old school, and very underreported. But last Monday in a note, PIMCO basically came out and said, we're really not lending the U.S., but we're pulling back from lending the U.S. Government money, which is a big deal. It's like a major escalation when the largest active bond manager on earth says that we're not buying long-term U.S. treasuries. That's a first. And again, this is what we've been talking about here for months now. It's that when you look at 30-year bond rates, the U.S. government is basically offering 30-year bonds, we'll call it 4.5%. And you could buy 1-year or 2-year bonds at 4.1%. What would you rather do? Lend the government money for a year at 4.1% or 4%, or lend the government money for 30 years at 4.5%. 4.5% is just not enough to lend the government money for 30 years, not when it is paying $1 trillion in interest costs a year, and not when both of the last two presidents, Trump number one and then Biden, added $14.5 trillion in debt. Now, why is this so alarming? Why am I ringing the bell? Because companies like PIMCO, very much like us, what I've been telling folks to do here for a couple of years is buy the short end of the curve, buy bonds no longer than a year or two, in treasuries even under a year, 30 days, 60 days, 90 days, whatever. Don't go beyond a year or two has been my policy. Personally, with my own money, and that's what I've advised people to do, of course. Now, a lot of other people are doing the same thing. PIMCO says, we'll buy short-term debt. We're not going to do it for 30 years at 4.5%. We'll lend you $1 million for a year at 4%, 4.1%, right? Now, here's where this gets very dangerous for the United States, and most folks just don't have the abstract thinking to perceive this, so I'm sharing this with you because I know you do, and you're concerned, and you're as patriotic as I am, and you're as concerned about our fiscal situation as I am. Here's the thing. Imagine a scenario where now, since everybody is really shying away from long-term bonds, 30-year bonds, the U.S., they're piling into 1 and 2 year, maybe even as many as 5-year bonds from the U.S. Now, if everybody starts buying 1 or 2 year bonds, the Treasury is forced to issue short maturity bonds. We'll call it 1 or 2 year bonds, because that's where all the investor demand is. Investor demand isn't at the long end of the curve, 30 years. It's now at the short end of the curve, a year or two. The Treasury is forced. That means every year or two, the Treasury has to refinance that debt. Now, let's just imagine a conflict with China breaks out, or Russia gets more insane. Something bad, we call them a Six Sigma event, happens. Something bad happens that spikes interest rates. When the Fed goes to borrow money again, in a year or two, if there's something really bad happening, they're going to have to pay outrageous rates to borrow money from investors. This is a real problem. The more you lend short term, that means that the sooner you're going to have to deal with that. Unless you adjust your long rate, your 30-year bond, up to where it probably makes sense, 7%, 8% right now, which would, of course, explode interest costs. I believe, and there are a lot of other people that believe, that the Federal Reserve is purposely holding down the long end. And basically, this speaks to complete market manipulation by the Federal Reserve, but that is a topic for another day. So today I wanted just to talk about the really unsettling historic news that PIMCO, again, the world's largest active bond manager on earth, is saying we're not buying long-term debt. We're just not lending the government money at 4.5%. Just doesn't make sense for us. So that's either going to force the Fed to keep selling short-term notes or force them to march up the yield on 30-year treasuries, which, again, in an environment like this, I don't see the argument for lower interest rates. I just don't see it jiving with the reality on the ground here. Anyway, that's all I have today. I hope you have a wonderful day.